pleasure to be speaking to Charles Kelly, the CEO of SEMA, and it's been a fascinating couple of days. How you emphasize the fact that boards ought to know a little bit more about what's happening in the way their businesses run. So, do you want to just explain what the shocking fact is and what they should be doing about it, Charles?
Yeah, I think there are two separate things. The bit that I thought was shocking was there was a piece of research done by an organisation called Black Sun, which is a UK company which focuses on corporate reporting. And their research indicated that only about 30% of companies was it considered that all of the directors understood their business model. And I think that is really shocking. We take out of this that we need to do to turn that situation around is really three things. One is, I think, is the quality of the information that goes to the board. And in that regard, the information is often very much focused upon the financial information and not on the business model as a whole. Secondly, I think that the boards need to look at really the key components of what they stand for. And yesterday at the conference we talked about the board mandate, which is a series of very simple questions, but the answers may be more difficult to give than one might imagine. And they range from what are the objectives of the company, what do we stand for, our values, but ultimately they involve the business model. And in that regard, and you and I talked about this yesterday, I think it's a very good idea to discuss with the board the business model and get buy-in from the board as a whole as to exactly how does the company what is the company's objective, what is it doing in terms of selling its products and services, and then how does it deliver that, and what are the partners, suppliers that it needs to help it do that. And I think getting that overall buy-in is very important, and the flows that go through it, and ultimately asking a particularly important question, which is how do you make money. And that question, again, very simple. If you look at the profit and loss account, you'll see we've got revenues of 100, we've got costs of 80, so the profit is 20. But it's actually, where does that actually come from, and what are the key drivers of it? And are those profits being created where you think it is the right thing to be doing to create those profits? So, for instance, in the UK we've had a lot of sales of insurance products which have subsequently been seen to be
dodgy,
missold.
Oh, okay.
Dodgy is a colloquial term. Missold is the regulator's term. And that's led to fines. So did the board? How should the board have been able to lead and manage on such situations? And then the third element is that then actually the board discussion, and you can get all your monthly reports, the quarterly or whatever, which say what's happening, but it's really about to me the important parts of the discussion are around the decisions and also around the operation within risk appetite. So here to give you an example, if you're working, if you're in a business where you're a financial business and you are taking decisions where you've decided that the level of loss, you have a 95% confidence that the loss will not exceed a figure. Let's say that figure is £1 million, million rupees, whatever you want. If your risk appetite is significantly higher than that, and you think it's a good thing to do, you go forward with your decision because you know you can take the worst case situation.
Yes.
But an interesting thing for the board to be discussing would be what is the real worst case situation? And 95% confidence actually creates a figure which is substantially less than 96% confidence and 97% confidence. Now, if you go to 100% confidence, you never do anything. We'd all be completely, risk averse. We'd just sit, like frightened rabbits in the headlights. But if you look at, a situation where 95% of the loss is $1 million, but 96% of the loss is 10 million, which is a perfectly possible situation now, then the board needs not to necessarily say, okay, well, we're not going to do it, but it needs to debate more carefully. What is it that could? What are the parts of the confidence that it doesn't have total control over? So, for instance, I'm on a board at the moment, and where we do home loans, and we have a model which creates our provisions. And an interesting issue there is, what are the assumptions within that model? And the assumptions, a very important part of the calculation of provision is where it is thought interest rates will go in the future. If interest rates go significantly higher, which is perfectly possible in the UK environment, then our provisioning will be not adequate.
Yes.
And so, again, the interesting issue is not for the board to say, oh well, okay, we accept that provision because it's in a business model which tells us that that's the right figure. It's actually then to discuss the assumptions and say, okay, where are we? And in the case of my home loan, for example, interest rates at the moment in the UK, the base rate is 0.5%. If interest rates went to 3% in the UK, that would be a very significant increase in the base rate. But it would still be, historically, a very low rate in the UK. And so the question is, a very simple question is, are we in a new economic environment, a new paradigm, where actually 3% is really a realistic high for the foreseeable future? Or are we actually misleading ourselves very substantially by staying at saying, okay, that's the maximum, so we can live with that situation? So it's to me it is starting with thinking through all the key questions which I said in the board mandate, and then saying, okay, now let's oversee the business on a day-to-day basis. But what we really want to focus on as a board are how we can drive the organisation forward, and then make sure we are resilient in mitigating our risks.
Fantastic. Thank you. I think that was a well-explained example.